For the next presentation of the business workshop, we have Cashflow tells the real story about your pharmacy. This is presented by our sponsor, RSM. Our speaker today is Peter Sackerson. Peter Sackerson has been providing expert pharmacy advice for 15 years, helping pharmacy owners to buy pharmacies, improve pharmacy performance, and manage their tax and cash flow. His pharmacy experience enables clients to receive an industry-focused service supported by local pharmacy knowledge. Peter is a fellow and national director of the Australian College of Pharmacy, writes a regular column in Retail Pharmacy and In the Know, and is a regular speaker at pharmacy conferences. Please welcome Peter Sackerson.
Thank you, Max, and sorry for the delay, folks. I thought my slides were here, but they weren't when we found them, and I think they're still the latest version, so we'll see how we go. So please excuse my stumbles if there are any. Thank you for coming along. I know it's lunchtime. I hope you've had something to eat, and otherwise, I hope I don't ruin your meal if you haven't eaten yet. So today we're talking about cash flow and why it's really the real story about your pharmacy business. And we're going to look at a few things. First of all, 4 key components of cash flow. And then we're going to talk about what is cash flow and where does it fit in. I know sometimes I talk to business owners and not just pharmacy owners, and you dig a little bit deeper when you start to talk about cash and the eyes start to glaze over and it's all a bit of a mystery. So we'll see if we can lift some of the mystery today. The third area is we're going to build a cash flow story, and just raise your hand if you didn't get a handout on the way in. You should have got a sample of the data we're going to talk about today. So just keep your hand up high, and we'll get a handout to you. So in the handout you'll have the data that we're going to use, as well as some of the summary of the talk on the other side. There's a second handout if you find that on the way out perhaps, which is an article I wrote, a reference to an article I've written about the dollar discount and how you might approach that in your pharmacy. So we're going to build a cash flow story and go through an example. And then lastly, we're going to see how cash flow is used to drive strategy in your business. Excuse me, the guys at the back, am I able to turn this around? Just move it around. That's better, thank you. So we'll start off, and where does cash flow sort of fit in? Where does it come up? I mean, we talk about accounts, we talk about accounting, we talk about profit and loss and balance sheets and expenses, but cash flow, as hopefully you'll come away with by the end of today, is really where all the action is, because it encompasses all of those things. And I really want to see that you shift your focus from, customer numbers and script numbers, all of which are very important things, but to just go up a higher level, and understand what's the cash that comes in and where does it go in your pharmacy business or in your group of pharmacies perhaps. So the 4 key components, I'm going to break it down I hope very simply for you, and we're going to try and help you all come out of here as being experts about cash flow. So we're going to talk about, we're going to break it down, and I've done that by breaking it into 4 components. Firstly, profit or loss. Are you making a profit or a loss? And we're going to look at the definitions of these things shortly after this slide. Secondly, we're going to talk about working capital as a second component, what that means. Thirdly, other assets and liabilities. And then lastly, owner's capital. So what are these things? So profit or loss, well, obviously, are you making a profit or a loss in the business? And cash does depend on you making a profit. Having more cash certainly depends on you making a profit. But what we do in the cash flow, we adjust that profit or loss by taking out of it any non-cash things, and probably the key one that we all understand is depreciation. You've run your business, you've bought some assets, and your accountant will usually put a depreciation charge through your profit and loss. That's really non-cash. It's an expense, but it's not cash. So we take your profit and we take out the non-cash things. Secondly, working capital. It's movements in what I call current assets and current liabilities. So what's current? Current is things that are cash or turn into cash within 12 months. So your stock, for example, hopefully that turns into cash within 12 months, or we're in trouble. Other current assets might include the GST that's owing to you, or your PBS claim that's outstanding. Current liabilities would include your creditors, your wholesale account, because you've got to pay that within 12 months, don't you? Okay. Maybe you've got a tax bill to pay, that's due within 12 months as well. So they're your current liabilities. So your working capital is what runs around the business every day, is your current assets and current liabilities. And then you've got your other assets and liabilities, so the fixtures and fittings, your bank loans, you've got to pay those back eventually, and other finance that you might have. And the fourth component that I outlined to you was owner's capital. It's a very important part of business. What's the equity that you have in your pharmacy? And in terms of cash flow, well, you can either put cash in or you can take cash out. And I know you're all good at taking cash out, and some of you are not so good at putting it back in. So we'll look at the impact of these things as we go through this afternoon. So where does it fit in? Well, profit and loss. Profit and loss statement. Profit does not equal cash. People look at their profit, and I know that it doesn't equal cash because people look at their profit and loss statement, and they look at me and they say, "Where's all the money gone?" So the profit and loss statement will measure what profit you've made, but not necessarily take into account the cash flow of your business. So, for example, when you pay your bank loan off, there's a major cash flow item going out that's not in your profit and loss statement. Okay? The balance sheet, it shows what we own and what we owe at a particular point in time. So, it doesn't measure the cash flow that's going through your business. It's just what we own less what we owe at a particular point in time. So that's what your balance sheet does for you. So the cash flow statement is going to measure the flows of cash through your business, and it's reflected in those four components that I've outlined for you today. And we're going to go through that slowly a bit later on. Any point in time, if I'm going too quickly, being too much of an accountant and you can't understand, please raise your hand, okay, and I'll be happy to answer your question. So what are the characteristics? Well, we've said it's not profit because profit doesn't equal cash. And that is a hot question from a lot of clients. You know, I'm making all this money, you're telling me I've got to pay tax, but I haven't got the money to pay. Where'd the cash go? And we'll soon see who the culprit is about where the cash went. If you're growing your business too quickly, you can actually run out of money. And so you can actually go broke by growing too quickly. I mean, if you take your business turning over $5 million, you might be carrying stock of about $500,000. And if you had a cracker of a year and you grew to 15 million, well, hopefully your stock went from $500,000 to $1 million. But in that 15 million, if you made a couple of $1 million worth of profit, but the stock went from 500,000 to 2 million instead, well, where's the profit? It's sitting in stock. It's not actually in the bank. And if you don't turn that stock over, you'll run out of money. And the wholesaler's account is due in 30 days. And if you haven't got the money because you haven't sold the stock, or your dead stock is rising and you're just turning over that stock at the top, you can run out of money. So you can actually grow too quickly and go broke. And you see it in other industries like the tech industry where they grow, and they got all this activity to handle, and they're trying to manage customers and sign-ons and this, and they're burning cash quicker than it's actually coming in. And lastly, you've got to look at short-term versus long-term characteristics of cash. So short-term is, can I pay my wholesaler's account when it's due? That's short-term. Can I pay my tax debt when it's due in about 3 months? And I know about it now. That's short-term. Long-term is you're making a couple of $100,000 worth of profit. You've got a couple of $1 million worth of bank loan. This year is interest only. So 5% on 2 million is 100,000, so your profit can cover the interest, not a problem. But after year one, the bank says to you, well, it's time to start reducing the loan, it's time to start paying off the principal, and we need to find another $200,000 after tax. And suddenly your $200,000 profit isn't cutting the ice. Right? So you've got to manage short-term and long-term cash flows. Know what's coming this year, but know what's coming in a year or two's time. And that hopefully helps you build your strategy about your business and your business model and what's going on in the business now. Because changes take time to take hold, and changes take time to come into your cash flows, into your business. So hopefully you're seeing from this discussion already that by talking about the cash story of your business, we're actually talking about the whole of your pharmacy business. We're talking about profit, we're talking about balance sheet, we're talking about bank loans, we're talking about tax. So all of those issues are the full complement of what's involved in running a successful business. And because we're doing that, we know that cash flow is central to our strategic planning. If your cash flow is negative this year, well, that's probably okay if we had an opening balance of cash to cover that negative. That's fine. If it's negative again next year, we're starting to worry because maybe that opening balance of cash is starting to run out. And the things that are making our cash flow negative aren't changing. They're not changing. And so negative indicates a lack of sustainability. You've got a business model that you can't sustain unless you keep tipping cash in from somewhere else. So it's central to strategic planning, and it's certainly good cash flow indicates good business sustainability. I've got a business that will keep going here. And poor cash flow directs management attention. So if my cash flow is negative, why is it negative? What's causing the negative? What part of my business is giving me that negative? And is it going to be there next year and the year after? Can I do something about it? And at the end of the day, whether or not you do something about it, reflects the management competence. Now, it may be that you personally, the owners, don't have the skills to see what the issues are and to perhaps take the necessary steps. But if you get the right advice and get someone in there alongside you to perhaps point you in the right direction, you might take it a bit further and overcome the issue. So it really is important that we move beyond KPIs, that we move beyond the profit and loss statement, that we understand our balance sheet, and then to really nail it, that we understand the cash flow of our business. And if we have more than one business, it becomes even more important because then you've got cash flows from 1, 2 or 3 pharmacies. And then you've got one pharmacy getting a fit out, so that cash flow is going to dry up a bit. You know, one pharmacy gets the big yellow warehouse next door and that starts to face a bit of competition. All of a sudden, out of the 3 pharmacies, one's got almost no cash flow and one's got a debilitating cash flow unless you do something about it, and you're still servicing the same level of debt. So it really does focus your attention. So now we're going to build a cash flow story. I'm going to take you through an example, and you've got the data there, but you can read that tonight on your way to the Las Vegas show while you're standing at the bar with nothing else to look at. And you'll see the numbers up here. We all know about profit and loss. So here's a simple pharmacy, straightforward numbers, turning over $3 million, good margin, million and 50. For the mathematicians, I think that's about 35%. We've got some expenses and we've got a bottom line. And we'll look at the percentages in there a little bit later. So we're feeling pretty good about ourselves, making $200,000 a year. We've got a balance sheet. Now, a few more numbers on this page. On your right-hand side is this year and your left-hand side is last year. You can see that stocks moved up. You can see that cash was there, it's not there anymore. We've got some other current assets we've done something with. Fixtures have changed. We've got goodwill, still worth $2 million. Perhaps. And we've got creditors, we've got bank overdraft, income tax, bank loan, a fit out, and then we've got equity, which has gone from black to red. Black and red's okay at the casino. In numbers, we don't want red. Red's no good. Black, 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 okay? So we can see the cash there has gone from 110 in the bank to 132 overdraft. So we could probably stop now, the whole talk, because we know that our cash has gone back by $242,500. Perhaps we want to look at why it's gone backwards and then make some decisions. So what I'm going to do now is move you through the 4 components. And as I said earlier, if I'm going too quick, please just ask a question. Because I want you to go out of here understanding that cash flow is important and that you really you know what to go and look for. You might need some help building this, but at least you're on the page. So first component, net profit. Hopefully we're off to a good start here. 225,000. We've identified the depreciation is 50,000, and just for the record, we've written off the old fit out of $50,000. It's non-cash entry, non-cash. So our profit of 225 at the starting gate is generating $275,000. Okay. So far, so good. Right. And the next part's important. It's the working capital, and why we look at working capital is, for example, in getting to this 275, that takes into account cost of goods sold, which takes into account opening stock, purchases minus closing stock. So the change of stock has been adjusted to arrive at profit, but we haven't actually taken that into account in terms of where the money went. And I'll show that to you on the next slide. So the second component is our working capital. And you can see there, and these components are all on the flip side of the handout you got, so they're there for you. So the first one there I've got, the arrow 2 is stock. It's gone from 300,000 to 400,000. So stock's gone up by $100,000. In terms of cash flow, that means cash has gone in or out? Out? Out. Cash has gone out because stock's gone up. We've bought some more stock. Got it? Great. The next line, our other current assets went down by $40,000. I'll let you know a little secret. This was a term deposit we had and we cashed it in. So the current assets have gone down. So we've liquidated some assets and brought some money in. Okay? So the stock went up, that means money went out. We cashed in a term deposit which brought money into our bank account. 2 out of 2? All right, we'll go for number 3. Trade creditors went up from 500,000 to 700,000. Okay. Now here's a classic example of the P&L not getting all our cash movements, because in the P&L we just record the purchases we made. We haven't, nothing to do with when we paid for them, right? Because we're doing accrual accounting, right? Accrual accounting is if you've sold something, what were the cost of that sale? So what was the cost of the goods relating to that sale? Not whether or not when did you pay for those goods. Okay. So here's why we need to look at working capital, because here we can see creditors has gone from 500,000 to 700,000. So the amount of money we owe API, Symbion, Sigma has gone up, which means they've effectively lent you $200,000, haven't they? They've lent you $200,000. So that we treat that as money in, or we adjust our profit to show that we in fact did generate an extra $200,000 in cash because we haven't paid the wholesaler yet. So our profit of 225 is plus 200 now because the money actually hasn't gone out the door to pay the wholesaler. And that's evidenced here. So far, so good? Okay. And the last one is tax paid. Now this one's a bit of an accounting thing. This one's a little bit tricky, but I'm sure we can manage it. You can see up there on our balance sheet that last year we had a liability of 50, and this year a liability of 67. Well, in this year we paid last year's liability, right? And the tax provision that's there is relating to this year. So that one's a little bit accounting, so there'll be a couple of those, but trust me, I'm an accountant. I had a client give me those as cufflinks once. Trust me, I'm an accountant. So when you add all those changes to working capital up, we get $90,000 in. And the $90,000 came in mainly because we allowed our wholesaler account to move out, to blow out. Okay? We have chosen not to pay them yet, which has left more money in our bank account. But not enough, as we know, we went backwards, so we'll keep going. So that's component number 2. Component number 3 is other assets and liabilities. So we had our fixtures. I told you before that we wrote off the $50,000, and we've now got $300,000. So we went and did a fit out for $300,000. And the bank said to us, have I faded? No sound. Oh, we're right down? Thank you. Am I doing something here? No? So the bank said to us, we're not happy to give you $300,000 on a long-term loan. We'll give you an overdraft and we'll give you finance of $150,000. Because we're not happy, you know, that we've got a sense things aren't right. So they gave us finance of $150,000. So we spent $300,000, they gave us $150,000 and the rest came out of our bank account. Right? So the $150,000 came out of our bank account. So $300,000 out, and you can see there $150,000 in. And the other bit of money that went out of our bank account was the bank loan, $200,000. Remember we had to pay that off? So our net result for the third component is that we've got a net out of $350,000. Okay? Any questions? Great. The last component then is owner's capital. Now again, this is another little accounting exercise, but so we've gone from 50 positive to 50 negative. How did that happen? Well, we take our opening balance of 50 and we add to it the profit for the year of 225, because that's part of capital. And we allowed for tax of 67, and the difference between all that and our closing balance is what we drew out of the business. And I've done that calculation for you, $257,000. I can still see some sceptics out there. They're saying this doesn't work. Okay, well that shows you that it does work. Okay. So we started right back at the beginning and we knew that our cash had gone backwards $242,500. And then we went through and identified the 4 components of cash flow: profit, working capital, other assets and liabilities, owner's capital. And we found where that 242 went. And the bad news is that it's a cash flow deficit. As I said at the beginning, I don't have a problem in year 1 having a cash flow deficit, provided we had the cash at the beginning of the year to pay for it. And we know that we only had 110 of that at the beginning of the year. We had to get an overdraft to cover the rest of it. So the bank said, we don't want to give you long-term finance on the fit out, we want to make it short-term, we want to see it paid off quickly. Any questions? Great. Okay, so cash flow talks. So we're going to see what the story is from this cash flow. And we want to ask ourselves, we want to see how we can change this. And how we identify how we change this is that we look at, are there any one-off inflows and outflows that won't happen from last year into this year? Secondly, we might say, are there any items that will still be there but they'll change, there'll be a different outcome? And having done all that, have we now got hopefully a positive cash flow going into next year? And if we don't, well, what's the plan? Are we going to accept a negative cash flow in year 2? If so, how's that going to be covered? So let's just say for next year, we're not going to do another fit out. And if you recall, our fit out was a net 150 out because we spent 300 and we got a $150,000 loan in. So that net 150 is not going to happen anymore. That's good. We found 150 straight away. However, the term deposit we cashed in, that's not there anymore, so we can't go and cash it in again next year. Or this year, I should say, coming. So there's 40,000 that came in that won't be there again. We've said our creditors won't increase any further. Right? We've hit the limit. They're looking after us. They're saying, well, yeah, okay, just keep it turning over. Let's leave it at that limit, but we don't want to go any further. So that's another 200,000 that we got in that's not going to be there next year. Our stock, we said, instead of increasing it by 100, we're going to get a bit tighter on it, and it's going to go down by 50. So instead of spending 100, we're going to reduce it by 50. So that's 150 turnaround. Our tax paid, we know, is going to be 17,000 more, we saw on the balance sheet. And the owner drawings, we think we got it covered, no change. What's the result? So you can see there, the left-hand side is the cash flow that we just saw for the year just past. Middle column are the adjustments. The right-hand side is the expected outcome if nothing else changes. So we said that we didn't talk about profit, so we left that where it was. We said our stock, instead of being 100 out, it's going to be 50 in. We said the tax paid is going to be higher. We can't cash in our term deposit again. We're not going to blow out the creditors anymore, so that's going from 200 into a 0. And no more fit-out finance and no more new fit-out. So we do all that, and unfortunately, our 242 only gets to 200. Minus. So it's still a negative. And then this year rolls on, and what do you know? Our friendly wholesaler says, look, we need you to pull that account back, and we'd like $100,000 over the next 3 months or 6 months. Look, deferred terms are attractive, but if they're coming out of your bank account over the next 3 or 6 months, they're not really deferred. Okay? It's in this year, it's still coming, it's short term, it's just smoke and mirrors, shifting deck chairs on the Titanic. It's still going to come out. And can you afford to let it go out? And then what if interest rates rise? So if we're paying 5% on our 2 million, that's about 100,000. That's 100,000 a year. If they go to, I don't know, if they jump to 6.5 on our 1.8, I think is about 117,000. So there's $16,000 or $17,000 more in interest we'd have to pay. And the bank might say either the rates might rise, which is probably, we don't think that might happen, but the bank might say, oh, the risk is higher. We want to increase the margin, for example. So we've got some more challenges. We've got to... Rob, you had a question?
Yeah, the tax that you're showing there that was going up by 17,500, you're saying that's expected to increase.
Yes.
What's the reason for that in this?
Oh, I just went 30% of 225 profit and that we had, the 225, and that gave us 67,500 tax, and last year we only paid 50. So we grew the business, we grew the profit, and the cash has still gone out the back door. Okay. So we've got to fix the 200. Can we reduce our owner drawings? Can we, not buy things at home? Can we, stop spending the money perhaps? Our bank loan, it's already on a 10-year term. Maybe we could, push that out over to 15 years. So our 1.8 million over 14 years to go, instead of being $200,000 a year, might be about $130,000 a year. So that could save us some more money if the bank would let us do that. What else can we do? Well, we didn't touch the profit line yet, so maybe the profit could be improved. And if I go to the next slide, you can see there a few more percentages. So the margin of 35%, Frank told us this morning that that's probably a bit light on now, but I'd like to bank 35%, that'd be great. but he says we should be able to get more. Our expenses, I think, at 27.5% of turnover are pretty high, by a good 4 or 5%, I'd think. But so there's another perhaps $120,000, $150,000 we might be able to find, and then maybe we can increase sales. Instead of doing 3 million, we might be able to do 3.5 million. And how are we going to do that? Are we going to get more dispensaries? Is it more retail? In the retail, is it more health? Is it more beauty? What's your offer? How are you going to drive that? And then we get into a bit chasing our tail a bit. If we're going to get stronger retail, do we need more stock? And therefore we need to put more money into stock. And we're sort of taking it with one hand and putting in with one hand, taking it with the other. But if we could get to $3.5 million and get 10% of $3.5 million as our bottom line, that's $350,000 profit instead of $225,000. So maybe that'll help. So if we did that and rescheduled our loan and took a bit less home and bought a cheaper car, or no boat, no overseas trip, maybe even put some money in. Put some in instead of taking it out. So there's a few other things there. Every 1% improvement in profit, we've heard a couple of talks over the weekend about the 1%. Instead of going for that big 25% increase, let's try 1% here and there. Maybe we can do a bit of both, get the sales to 3.2 million, but get the profit up by a couple of percent. Again, 10% of 3.2 is 320 instead of 220. So in our sample that we've just been through, there's some decisions required. I think we've got an urgent profit improvement position to address. We've got to manage our stock. We've got to manage our drawings. And generally be looking at the cash flow that we've got in our business and attacking it and not just letting it happen. For most people, cash flow management consists of going online and looking at what's in the bank account. Right? That's not cash flow management. That's just seeing what's happened. I'm talking about making it happen. So that when you do go online and look at the bank account, there's more there. And as we've seen, managing cash flow takes you to all aspects of your business. If you can identify those 4 components as to what's happened in your business or in your group of pharmacies, then you can really take a decision about a sort of in each area. So if you're running 3 pharmacies and you think profit needs to be more, well, then let's break that down and look at each of the businesses and see what's the profitability in pharmacy number 1, number 2, number 3, and is that going to be there next year, or is that number 1 got the fit out happening and we're going to be closed for 8 weeks, new brand, lose sales, got to get them back. What's that going to do to your cash flow? Have you negotiated a landlord contribution? When is that going to come in? Are you borrowing more money on the fit out? When do the repayments start? So by starting with cash flow, we're actually covering all of our business management. And at the end of the day, cash really is king, right? You've got to have it in the bank there. So in the groups, individual store performance is very important because it's not about improving your group sales. It's about going to each business and saying, can I improve the sales in that pharmacy and how am I going to do it? Can I improve the sales in that pharmacy and how am I going to do it? So it's still very important to measure each store, have those KPIs happening, but don't stop there. Extend it into this sort of view of your business at a high level. And so managing cash flow on your balance sheet at a group level becomes very important because most likely you've got a debt that's across the businesses. It relies on a loan evaluation ratio against all of the businesses. Or perhaps you've managed to get the debt secured on 2 out of the 3 only, so the 3rd one's unencumbered, but the bank won't be real happy if the values of the other 2 drops and therefore they want to bring the 3rd one in. So managing your balance sheet, managing your cash flow across the group becomes very important Do you get a group balance sheet presented to you? You know, what does my group balance sheet look like? For example, I've spoken about managing store downtime and fit-outs. So the cash flow completes your management toolkit. I said at the beginning, and hopefully that's been a clear message today. So that's where it fits in. So your store KPIs, have you focused on the store challenges, the profit and loss statement for that store? Make sure that you're focusing on getting that store performing. Your group cash flow and group balance sheet, though, really brings it all together as to where you stand as an empire, if you like, or as a business entrepreneur, as a business group. So get your store P&Ls happening, but really understand where you sit as a group when it comes to cash flow and balance sheet. Many people I talk to take an approach to debt management and balance sheet management that simply is based on LVR. If I haven't borrowed 75%, I'm okay because I can still borrow some more if I want to. Well, that's not the point. That's not managing, because it may be that your cash flow is going south and the value that you're doing your LVR against is actually dropping. Okay? So managing cash flow is not about, can I borrow more money? Have I got, LVR? That's not managing it. That's not understanding your cash flow. So hopefully you can see that from there, that cash flow is the real story, and that you'll take an interest in that and have one done for your pharmacy business. Thank you very much. Sorry, if I can if you're wanting to catch up with us later, we're down at stand 189. We've got RSM people here from around the country. So we're a national accounting practice, and we can help you anywhere in Australia.
Do you want to take some questions?
Yeah.
Thank you, Peter. We're just going to have a microphone at the back. If anybody has any questions, if you just raise your hand, we'll come along to you.
Thanks, Peter. My question is, stock management is key for, cash flow, obviously.
Stock management, yes.
So do you set cash flow purchases for your stores? So if you're running multiple stores and you've got managers in charge of purchasing, do you set them a budget? Would that be useful rather than just a replenishment or having a goal for what you want to spend at the end of that month, at the end of the year?
In certain circumstances, a purchaser's budget is essential, right? So particularly when you're trying to reduce stock, because you've taken a decision that your stock turn is not enough, and I think you really need to have your purchasing people understanding how much they should be buying each month. So I certainly believe that in the circumstances where you're trying to reduce stock, you should have your hand right on what the purchases are. As a general rule, if your stock turn is under control, then I think it's not so much the purchaser's budget, it's about the stock turn of your different lines.
Yeah,
and
so
managing that.
your dead stock as well.
Yeah.
Peter, the other day I was reading an article about, not more so about cash flow, but about balance sheet items. And some accounting firms are now taking the term of your lease and the value of your lease and adding that as a balance sheet item as a liability. Have you heard much about that and what's happening? And that will then affect LVRs.
So what I think you're saying is that if I've got a 4-year lease to go, that's a liability that I've signed up for, and they're including that as a liability on your balance sheet. I understand the accounting standard around that, which says you disclose that as a future liability, but it's not a liability today. I would see that as overkill, because also there's a future revenue stream against that liability, isn't there? Yeah. I haven't seen any banks request that, for example.
Thanks for the presentation, Peter. I don't intend for this question to be overly simplistic, but what you've shown us there is a annual cash flow statement.
Yes.
So if I wanted to do a monthly one, will I just divide everything by 12? Or is that overly simplistic?
You're going to do a monthly one, as in...
That's right. So if I want to do it on a monthly basis and accrue it through the financial year, so
Yeah,
compound, adding each month as they come.
all you need to do is set up to do that at the end of each month with your balance sheet. Because to do a cash flow, you need your opening and closing balance sheet. So it'll be the balance sheet for last month and the balance sheet for this month, and the profit and loss statement for the month. And then you can do a cash flow statement for the month.
Yeah. But how do you use your previous 12-month statement moving forward if you want to look at your last year versus current year?
You could go back and do that. But you need to have your balance sheets right every month, because if you're not doing your creditors right and all that sort of stuff, you're not really going to measure it properly. As a practical exercise, I would say you'd look at it every quarter and make sure that every quarter you get your accounts spot on, and so you get cash flow right. And the higher the debt, the more frequent the cash flows.